Is this the biggest lie from the Federal Reserve yet? Now, you wouldn't expect our leaders to lie to us, would you? I mean, the president, central bankers, the Supreme Court judges, you trust them all to tell us exactly what they're saying, right? Well, you better believe that every single word the Federal Reserve says, the Federal Reserve that controls the economies of both the United States and the world, they're busy telling us what they're doing, what to expect, and how to prepare. And you better believe that every single word they say is measured and it matters. So they'd be careful with what they're saying, right? Well, in this video, I'm going to break down some of the things that they've said. We're going to look at the truthfulness of them. Then we're going to see what are they telling us today, what to expect with our own retirement accounts, and then we're going to look at the charts and the graphs that tell us what's really going on and what we need to be doing to be prepared for what's really happening, not just what they're telling us is happening. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything you've learned is wrong, and now today, almost everything they're telling us is wrong. If you're going off of what they're telling you, it's going to be bad for you. So we're going to look at the actual data behind it so we can be better prepared for what's really going on. Now, I do want to tell you real quick before we jump into this, I got a lot of charts and graphs we're going to cover, but I am going to have about an hour presentation I'm going to do next week where I'm going to have all types of charts. We're going to dig in super deep so we can see the factual information of what's really happening. I'm going to break down what I'm selling, some things that I'm buying, what I'm waiting for to see before I move in bigger, what my portfolio looks like, so much more. And then, of course, I'm going to do a live question and answer. So a time you can get with me to ask me all the questions that you have about all this information. You don't want to miss it. There's a link down below. It's the most important time. They're lying to you. You need to see the real information. Check out that link down below. Join me live, and I'll show you the charts and you can ask me questions. All right, now getting into this video. Can we trust our leaders? Now, this is somewhat of a rhetorical question. Of course, the answer is no, right? Or maybe you still think it's yes. So let's take a look at that. So let's look at a couple things. Now, we're specifically talking about the central bankers, the leaders. I'm not going to dig into all the politicians. We'd be here for days. All right, but when we're talking about the politicians and the central bankers, so we had Ben Bernanke. He was in charge of the Federal Reserve. Today, it's Jay Powell in charge of the Federal Reserve, the central bank of the U.S. Before that, it was Ben Bernanke back in 2008. Now, you might remember this if you're old enough, and if you're young, you might not remember. But as you can see right here, January 17th of 2008, Bernanke, the head of the Federal Reserve, said the Fed is not forecasting a recession. So in 2007, the wheels were already starting to come off the bus. Everybody already knew it was going to happen. And Bernanke said, no, everything's good. The Fed doesn't see any recession coming. It's all good. Clear road ahead. Keep going. Federal Reserve Chairman Ben Bernanke said that even though the U.S. economy is facing a difficult combination of circumstances, the Fed is not foreseeing a recession. So this is important to understand. I'm going to break this down. Look at what they're saying. Even though the U.S. economy is facing a difficult combination. So I'm going to show you what they're saying today. Even though we're facing a difficult conversation, they're not forecasting a recession. The U.S., quote, the U.S. economy remains extraordinarily resilient. The U.S. economy is strong, sort of like the White House press secretary saying that they feel the economy is strong and ready to take on all this inflation. We're going to take a look at that. Don't worry, we'll show you the charts. And it says that growth will be worse this year. I mean, sure, we see some problems, but we're not going to have a recession. Of course, that was right before the GFC, which is the great financial crash, the global financial crash that brought down the entire banking system. So we'll take a look at that. So that was that. Now, did we trust him? Did he lie, or was he incompetent? A question I'm going to keep asking you. We have Janet Yellen. She was in charge of the Federal Reserve before, after Bernanke, and then she's now in charge of the Treasury. So here we have her in 2017 saying, I don't see a financial crisis occurring again in our lifetimes. We're never going to have another recession in our lifetimes? That's what she said in 2017. Now, we've had a couple of them. One at the end of 2018, of course, the March 2020 crash, and then holy moly, what's going on right now? So this is who is in charge of our financial system. We don't see it happening in our lifetimes. Of course, the Federal Reserve right now today, this is what they're saying now. This is dated a couple of days ago, June 28th. The Federal Reserve President, Jay Powell, pushes back on the recession fears. Hey, hang on. Don't get fears. The economy is strong. Does that sound sort of like what Bernanke said? The economy was strong, right? We can see that, of course, that's what Janet Yellen and Jay Powell are telling us. The World Bank chief says something different. He says that they're skeptical about the ability of the U.S. to avoid a recession. Look, the U.S. is engaged in demand destruction. They're trying to destroy demand. They're crushing the stocks so you don't spend so much money. And they're skeptical that the U.S. can avoid a recession. I think even they're wrong. All right. Now, let's take a look and see a little bit more. Now, a question I'm going to keep asking is, are they liars or are they incompetent? So they either know what's really going on and they're gaslighting you, they're lying to you to keep you engaged in the markets, even though they know they're about to crash. They're basically asking you to make horrible decisions off of faulty information on purpose, or they're completely incompetent and they really think that things are going to be good, even though everybody knows they're going to be bad. So are they a liar or incompetent? Leave me a comment down below and tell me. The thing that I would ask back is, regardless, it doesn't matter if they're a liar or incompetent. In either situation, they shouldn't be there. Leave me a comment, let me know. Oh, while you're at it, hit that like button and hit that subscribe button with the bell notification so you know when I put new videos out. All right, thanks. Now look, some people maybe are even a little bit smarter. Some people might even be a little bit smarter than the people who are supposed to be leading this. Who's Cardi B? You might know her. She's a, I don't know, musician, a rapper, whatever you want to call her. And she is pretty outspoken when it comes to politics. She's certainly no PhD economist like Janet Yellen and Jay Powell are, but she says here a few weeks ago, June 5th, she said, when y'all think they're going to announce that we're going into a recession? Got 131,000 likes. When do you think they're going to actually announce that? Because they're saying, hey, everything's fine, right? Well, that got some attention. As a matter of fact, it got the attention of Janet Yellen, who went on to say, well, she said, I'm not going to announce it. When do you think they're going to tell us we're going into a recession? Janet Yellen says, I'm not going to announce it. And I don't think we're going to have a recession, end quote. Don't worry, I'm going to show you the charts. Hang on. Yellen said, quote, consumer spending is very strong. Does that sort of sound like what Bernanke said in 2008? Investment spending is solid, but we expect growth to slow down. Remember what Bernanke said? The economy is strong, but we expect things to slow down. Sounds like they're reading the exact same script. Quote, we have a very strong economy. I know people are very upset, and rightfully so, about inflation. Hey, look, I get it. You know, we printed way too much money. We put all these stupid policies in place, and you can't afford to fill up your car with gas anymore, and you can't afford to take that summer vacation. I get it. You're upset at us. Well, you shouldn't be upset at us because we didn't really know that it was going to be our fault. But don't worry. Everything's going to be okay. That's what she's saying. Now, are they liars or are they incompetent? Well, let me play this little video clip of Jay Powell, Jerome Powell, the head of the Federal Reserve, and let's hear what he has to say.
One way to say it would be, I think we now understand better how little we understand about inflation.
That's not very reassuring.
No, honestly, this was unpredicted. I was looking at our at the time of our June meeting 1 year ago, of the 35 people who filed with a survey of professional forecasters, 34 of them had inflation below 4% for last year. And of course,
so, well, you heard it from his own mouth. They're incompetent. They have hundreds of PhD economists, thousands of researchers. He's leading the global economy by creating booms and busts, by putting money in and out. And he admits he doesn't even know. So I guess I would put him in the incompetent camp unless he's lying about not knowing. Either way, it doesn't really matter. They shouldn't be doing it, either if they're a liar or incompetent. Leave me a comment. Let me know what you think it is. All right, now, no recession. So they say there's no recession. Janet Yellen says we won't see another one in our lifetime. Cardi B says, are you going to say we're in a recession? And Yellen says, no, we're not having one. Okay, well, let's take a look at that. What is a recession? Let's first look at this. What's the definition of the word? Let's make sure that we're all using the same terminology. From Investopedia, a recession is a significant decline in general economic activity. Okay, well, how do you measure that? It's recognized as 2 consecutive quarters. It's 3 months and 3 months. 2 consecutive quarters of economic decline, of GDP going down for 2 quarters, as reflected by what? GDP. All right, that's how you quantify it. So we're on the same page here. Not how it's defined anymore. It says that the 2 consecutive quarters of decline in the real GDP are not how it's defined anymore. Now they define a recession as a significant decline in economic activity spread across the economy lasting more than a few months. So a quarter is 3. So I don't know what a few is. A quarter is 3. 2 quarters would be 6 months. All right. Normally visible in real GDP, real income, employment or unemployment numbers, production, and retail sales. Okay, so let's look at those couple things over the last couple months. Now, right off the bat, we're going to pull up the GDP. So this is the U.S. GDP, gross domestic product. It contracted by 1.6%. That's negative 1.6. That's negative growth. So as you can see in this chart, we had 2020 went negative. Of course, the entire economy was shut down on purpose. It wasn't the pandemic that was the problem, it was the response to the pandemic. And then we had this huge growth because then it opened back up and everything boomed with trillions of dollars dumped into the market. But here we have, it's been slowing, and here we have negative. This is negative growth trending down, okay? Always look at the trend and look at. So we're negative growth, that's quarter 1. All right, where are we for quarter 2? Well, quarter 2 hasn't officially closed yet. Today it will officially close. But what we can see right here is that the latest estimate is as of June 30th, is a negative 1% GDP growth. All right, so here we have from the Atlanta Fed, this is the GDP now estimate. Here's 0, and here we are well below 0. So that's 2 quarters, 6 months of not slowing GDP as would be defined in a recession, but actually negative GDP. So that's what the quantification of it is. That's the definition. She says we're not having it. Are they lying to you? Let's dig into some more of the numbers. What about the other numbers? They say we have a very strong economy. Let's take a look at this. Now look, this isn't all about doom and gloom. Let me just tell you real quickly, I learned a long time ago in my investing career, there's no such thing as good and bad timing. There's good and bad strategies. All right, so there's always opportunities in every market, but only if you're looking at the real information, the accurate information. And of course, they're lying to you, giving the wrong information. So we're going to look at the real information so you can make the right decisions. There's always opportunity. It's not doom and gloom. Okay, how strong are we? Well, let's take a look at the inflation numbers. So we can see that inflation is a problem, specifically in housing. Now CPI, Consumer Price Index, measures housing. It doesn't measure the price of your home going up. It's a owner's rent equivalent. So looking at the price of the rents. So here we have CPI in it says owner's equivalent rent. And look at the growth of CPI right there. So CPI is the increase of price, and you can see how fast that is shooting up. So that appears to be a problem. As a matter of fact, if we look at rents across the United States, we can see that a monthly look at average rent prices trends in the United States are way up. A 1-bedroom is up an average of 25%. A 2-bedroom is up almost 27%. That's the national average. Some places are up more than 100% on rents. 26% is only the national average. So how is the economy looking? It's not looking so good, is it? As a matter of fact, we can see here, I believe this is from Bloomberg right here. In a recent category, we have this from Bloomberg. About 15% of U.S. renters aren't caught up with their payments. They're not even able to keep up with those payments, but it gets worse. Gets worse this summer as many leases come due and landlords boost prices. So stocks, cryptocurrencies, it's called mark to market. Every single day, every single minute, we know what the price is. The price is always live, right? But with real estate, it's a little bit slower, specifically in rents, because you sign a year lease. When the lease is up, then the landlord can raise the prices. So it has sometimes a year lag. So we're expecting that this summer, as these leases come due, the landlord will boost prices. So we think rent prices are going up high now. 15% of people can't even afford it now. Wait until the price increases go up. That represents 8.4 million Americans who are struggling to pay their monthly rents on time. So again, I'd ask Janet Yellen, I'd ask Jay Powell, so how is that economy doing? It's really strong, right? 15% of renters are in payment. Rents are increasing faster and faster. And by the way, the numbers are completely fudged because the owner's equivalent rent is completely misrepresented. I'm not going to dig super deep into that right now. If you want to learn about the CPI and how it's made up, leave me a comment down below. All right, now what else? Let's look at some more data. The consumers. The consumers are breaking. What do I mean by that? So the prices of everything's going up. Food's getting more expensive. Your house is going more expensive. Your rent's going more expensive. The gas is getting more expensive. But what about your wages? Well, we can see that the wages are falling behind inflation. So prices are going up 4% faster than your wages are going up. And that's if you believe the price going up metric, the CPI number, which of course is completely wrong. We also see that savings and income are plunging, so we can take a look at this. Again, don't take my word for it. Let's go ahead and look at a couple charts so we can see the consumer squeeze. So this is real wages of growth, and we can see, remember, it's always the trend. What's the trend doing? Now we can see that we're very, very low historically, but more importantly, it's the trend. This yellow arrow shows us. So that's real wage growth. It's going down, meaning you might be making a little more money than you were before, but because prices went up even faster, you're technically making less money. It's not about, you always have to think about things in terms of purchasing power. All right, now savings as a percent of disposable income, again, what's the trend? It's going down. As a matter of fact, we're back to kind of historical lows, but again, it's the trend that's the problem. So savings are going down. So again, how's the consumer doing? The economy is super strong. We can handle this inflation, really? Because the data doesn't show me that. All right, what about else? Homes and mortgages. Well, we looked at rents. What about homes and mortgages? So there's something known as the wealth effect. When my home goes up in value, when my stocks go up in value, I feel more wealthy. And so I spend more money. Even though I'm not going to sell my home, and even though I'm not going to retire for whatever, 20, 30 years, I still feel more wealthy, so I spend more money. When my retirement accounts and my home goes down in value, I feel broke and I don't spend more money. And that affects, of course, the economy. So we can look at the homes. We can see that the 30-year rate, the mortgage rate, has doubled, all right? Now, and we're talking in just a couple of months. That means that home prices are now up over 56%. And what does that do? That curbs spending. So we can see this in an inverse relationship. So this right here is going back to 2015. The red line is the consumer sentiment. All right, University of Michigan takes a survey. It's one of the standards that we look at in the industry, and we can see that the Michigan Consumer Sentiment Index is in red, and in white is the 30-year mortgage rate. And look how closely they track. I mean, look how closely that track together here. Track together here, but look at this divergence right here, right around 2020, and all of a sudden you can see consumer going down, of course, because we have March 2020, the economy was shut down, of course, the sentiment went down. It makes sense. It snapped back as things got back open, but now look at this divergence. So up here we have mortgage rates going higher, and down here we have consumer sentiment. We do not want to see that happening. People are feeling broke. They're feeling negative about the economy. They're going to spend less money. So the numbers they're giving you about the economy are wrong. What else? All right, now what about unemployment? Now, hang on. Before you get all worried, I know it sounds all doom and gloom. Look. We just have to know the real data. As long as we know the truth, we can manage around it. Remember, there's always good and bad strategies in any time, okay? So we just need to know the data. At the end, I'm going to tell you what we're going to do about it. Oh, and also there's a link down below if you want to join me next week. I'm going to do a full presentation. We're going to do a live Q&A. So check it out, but I'll show you some stuff at the end. All right. Unemployment's rising. So we have a rise in part-time workers. So what does that mean? Well, that means either one, people aren't able to find full-time employment, so they're taking part-time, or two, they have to take second jobs, meaning they're working full-time and they're working part-time. So seeing a rise in part-time, that means the economy isn't strong, like, of course, Jay Powell and Janet Yellen and the White House press secretary are telling us. All right, we can see that these types of things preceded the 2008, remember, the great financial crash that the Fed chair Bernanke said wasn't going to happen. And we can see that the jobless claims are increasing. Again, we don't look at headlines because they're lying to us. We look at the actual data. And what we can see here is the red line is the employment part-time. So we can see this is 2000 to 2004. This is the great financial crash right here. And so what we can see is this red line is the increase of part-time employment. Now, part-time had been going down, and then here we go back to a spike. The white line that we see moving almost in lockstep is the U.S. unemployment rate. total in labor force seasonally adjusted. So we can see they basically moved together. They both spiked really high in 2008. They both came down. They both shot up in March 2020, of course. They both came down. But here's the problem. Do you see this yellow arrow? Do you see it's showing us that they're starting to spike again? That precedes. We're looking for, there's lagging indicators. Lagging tells you what happened. We want to look for leading indicators that tell us what's about to happen. This is a leading indicator to tell us that the unemployment rate is spiking. It's not good for the market. The economy is not good. Now, what about the U.S. deficit and GDP? So the amount of debt, how short is the government on their obligations they have to pay versus the amount of revenue they bring in and the GDP, the gross domestic product. So what we can see is that long-term interest rates are rising fast and the deficit to GDP is increasing. So long-term rates are increasing. So that means the interest rate on the bonds. So you have the yield curve, right? So you have the short end of the yield curve, which is a 2-year, 5-year, 10-year. Then you have the long end of the curve, which is a 30-year, and that measures the amount of risk or the sentiment of where investors think the market will be in the future. And what we can see based off of the fiscal deficits and the interest rates, we can see that it is spiking right here in the red line right here. This is the change in the fiscal deficit to GDP. So this is the percentage, deficit to GDP in percentage terms during all recessions going back to the 1970s. I like to look from 1970s forward because that's when we got off the gold standard, so that data is a little bit more relevant. So what we can see here is this is the COVID recession that we're in right now. And you can see how high it's still spiking right here at the end. If we go back here, this is the S&L crisis in the 80s. If we want to go back to the this is the GFC, the global financial crash right here. So you can see that, but you can see that the change in the fiscal deficit, the government's ability to continue to pay for the entitlements things they have to pay, is in a serious, serious situation. And then the question that I think everybody wants to know is, when will the Fed pivot? Well, first of all, I haven't been to AA, but I hear all the time admitting you have a problem is like the first step. So if the Fed won't even admit it, Cardi B calls out and says, when y'all going to set the call it a recession? Janet Yellen says, I'm not going to announce it and we're not having a recession. So the first step would be, hey, shoot, we have a problem, we should do something about it, but they're not there yet. So when's the Fed going to pivot? Well, not until they probably admit they have a problem, all right? But what are they looking at? We want to try to, remember, have leading indicators. What are they looking at? When will they need to act? Well, it's actually not that hard, all right? Let me show you a couple things. So the first thing is you have to understand, what is the Fed doing? They have a job by Congress. They have something called a dual mandate. There's two things they're responsible for, two things. And so if they're not doing those two things good, then they need to fix them. So what are they? Well, let's take a look at that. So the dual mandate, first of all, in 1977, Congress amended the Federal Reserve Act, stating the monetary policy objectives of the Federal Reserve as, so this is their policies, maintain long-run growth of the monetary and credit aggregates, so maintain long-term growth of credit and money, all right, increase production, make sure the economy is growing, GDP is growing, which I just showed you 2 quarters going down, so that's not happening. So as to promote effectively the goals of, okay, here's where we get the dual mandate, the goals of what? Maximum employment, stable prices. Maximum employment and stable prices. Those are the 2 objectives. And moderate long-term interest rates, that's kind of like a third one. Stable prices, interest rates, they kind of go together. So those are the 2 things that they're responsible for, maximum employment and stable prices. So that's what they have their eye on. So we should also have our eye on those 2 things. So let's take a look at that. We want to watch those 2 things. What we can see here, stable prices. So this is CPI, Consumer Price Index. And as we can see right here, for the last, this is 2007, prices have been pretty stable. This line right here is 2.5%. All right, 2% is the number. I'm going to show you that in a minute. About 2.5%. The prices sit right about there. This whole section, we are right on the number. This whole section, we're right on the number. But look at this. Does that look like stable prices? Does that look like they're following their mandate? Well, to me, it certainly doesn't, and it's not just what I think, it's what they're telling us. Now this part, I would believe them on. Well, I don't believe them 100%. Jay Powell from the Fed says they're strongly committed to bringing inflation back down to 2%. This is as of a couple days ago, June 22nd. So they're firmly committed to getting back to 2%, but 2%, they're at almost 9% today. So prices are certainly not stable, so they need to bring them back down. So we're watching that. I don't think they're going to be pivoting until they're starting to get prices back down to close to their mandate of stable prices. What else? Well, we also want to be watching unemployment. If we see unemployment starting to jack up, that's going to be a problem. Now, we're not seeing it 100% in this chart for a couple reasons. One, the way they calculate this is highly manipulated, sort of like CPI. But as I already showed you in the other chart, looking at the part-time employment, we can see how that's spiking, which is more of a leading indicator than this. This would be more of a lagging indicator, but we're watching both of those numbers. This is what the Fed is going to pivot on. So if they can start getting prices back down to be more stable, or unemployment starts getting away, that would cause them to want to pivot. The other thing is we want to watch credit liquidity. They want to make sure the banking system works. Ultimately, the Fed's there to backstop the banks. They don't want the banks to crash. And so the credit markets are important to them. They want to make sure they're working. That's what happened in 2008. The banking system froze up. And so the credit markets signal caution as U.S. spreads surge past key levels. So right now they're in caution. They're surging past key levels. You can see this. This is investment grade credit risk premiums. And so we can see that they are breaking out of this level right here, and that means danger. So those are things that we're watching for, and I believe the Fed will pivot when those things force them to. So now that we know that, now that we know they're lying to us, or they're so incompetent they don't know, or they're lying. You tell me in the comment down below. We know that everything they tell us is wrong. We have to get our own data, which I've given to you. What does that mean? Remember, I said this isn't all gloom and doom. We just have to have the right information so we can act accordingly. We can act properly. So what do we do to prepare? All right, so remember, no such thing as good and bad timing, good and bad strategies. So I've been talking about since the end of last year, there's been a massive rotation in the market from growth, high growth, tech, into real things, commodities, energy, metals, things like that. All right, I've been talking about for a long time. When they continue to print an endless amount of fake counterfeit fiat money, people want to buy real hard things. Turns out we still need things like food and fertilizer and energy. Who would have thought? We still need those things. So the market's just moving. There's a lot of money to be made just in other assets than you might have been looking at. The other thing is that we also want to be hedging positions. Now, hedge funds get their name from hedging positions. So if you're really long, let's say that you have money tied up in your managed accounts, your 401ks, and you're long on a bunch of things, you can't really touch that, you could hedge that. You can easily put a couple shorts on the indexes with just one click. You don't really have to go borrow the money. Super easy. You can hedge your position so when the market goes down, you make money. The other thing that I'm really doing is I'm adding more dry gunpowder. I believe that the markets will continue going down per the data, and I want to be ready to scoop these assets up when they go on sale. So my percentage of cash that I'm holding is larger than normal, and I'm actively growing that. So I've been selling some of my assets in sectors that are rotating out of, putting that into cash. All right. Anyway, that's what I'm doing. These are the three things that I'm doing. And I've already gone long on this video, so I'm not going to break it down even more. But you can join me next week if you want. We'll go live. I got a whole bunch more charts I'm going to show you. I'll dig more into the sector rotations. We'll look at actual assets I'm buying and selling. You can ask me all the live questions that you want. There's a link down below. And that's what I got. All right. Now, if you're not already subscribed, please click that subscribe button. Hit the bell notification because I've heard that I'm being shadow banned. Maybe you're not seeing all my videos all the time. Of course, like this video if you like it. And if you don't like it, that's okay. You can give me a thumbs down. I'm okay. But at least tell me why. Leave me a comment. Let me know why. That's what I got for you today. All right. To your success. I'm out. Since you've stayed to the end, I know you like this video, which means you're probably going to really like this video right here and this video right here.